Thanks, Nina. So nice to have everybody tonight for a topic that has a lot of detail, but almost all of it is important detail because if you've been saving in retirement plans during your working years, at some point, you do face decisions about taking the money out, and the rules are, there are a number of rules, and having a general understanding of them can make sure that you don't make some of the more easy to make mistakes. Now, since Nina already introduced me, we can skip that, but I do want to point out that what I do is education and it is not advice. That means that when we finish tonight, I hope you will say things like, I learned this and I need to make a decision about, fill in the blank, instead of saying, Karen Chan said I should fill in the blank, because I'm not giving investment advice or tax advice or retirement planning advice. I'm trying to give you information so that you can then either on your own or with the help of a professional, apply it to your situation. And if you do, I'll just say this here at the beginning, if you do feel that you want to look for a person to work with on whether maybe it's not just this, maybe it's estate planning and it's income taxes and so on and so forth. On my webpage, which I've listed here, KarenChanFinancialEd.com, there's a tab labeled resources, and there are a couple of items on the resources list you may want to look at. One are links that are specifically related to tonight's program. And so you'll look for taking distributions from retirement plans. The other would be finding financial advice that's right for you. And there are a number of resources there that might come in handy if you are wanting to particularly look for a financial planner, but even if you're looking for someone just about investments or so forth. So what are we talking about tonight when we say retirement plans? Well, if you look at the blue box in the middle, our retirement plans in the United States come in two flavors. We have the traditional type of retirement plans, which when we think about their tax nature, they are tax deferred. We get a tax benefit when we put money into the plan because we don't pay tax on that part of our income that year. We'll pay tax on that income and the growth in the account when we eventually take it out. Roth versions turn that on its head. With a Roth version, there is no tax break in the year you contribute to the account. The tax break comes down the road when you're able to take the growth out without paying any tax on it at that time. And then depending on where you've worked or whether you set up your own retirement account, you might have an IRA, 401k, 403b, 457 plan, and the rules that we talk about generally will apply to all of those. There are actually a number of ways to take money out of accounts. Where we're going to spend the most of our time is on the last three: rollovers and conversions, regular distributions, meaning I'm taking it out in retirement to use, and then beneficiary rules. But because of the pandemic, we're going to start off spending a couple of minutes talking about loans and hardship withdrawals, because there were a couple of rules that the window of opportunity is passed on for these special rules during the pandemic, but I want to mention them in case any of you did do one of these so that you know what you need to do at this point. So as far as loans may be available from most types of employer plans, meaning 401ks, 403bs, and 457s, but the law doesn't require these plans to make loans available. And so you can only take a loan if your plan allows it. And the usual limit is the lesser of either half of your vested balance, and if you've worked at someplace less than 5 years, you may not be 100% vested yet, but the lesser of half of your vested balance or $50,000. There's an exception though, if perhaps you don't have that much in the account. If your vested amount is under $10,000, then you could actually take the entire amount. And again, these are the permanent rules that we're talking about right now. You have 5 years to repay those loans, longer if it was used for a home purchase. The catch is that if it's not repaid and you leave employment for whatever reason, if you leave employment, the unpaid balance is going to turn into a taxable distribution, which could also mean that if you're under age 55, that it could also incur a 10% penalty. I put 59 and a half here because that's the general age at which you no longer have early distribution penalties. But from employer plans, if you leave the plan, if you leave the employer after the age of 55, that is an exception to the under 59 and a half early distribution penalties. The one way to work around, if you leave a job where you have a loan that you haven't paid back yet, if you can come up with the cash and deposit that unpaid amount, or at least money equivalent to the unpaid amount, into an IRA, or even if you can come up with part of it, they will be treating that as a rollover, and you wouldn't be having to pay tax and potentially penalty on that. So those are the standard rules for loans. Now, last year, under the CARES Act, during the period from March 27th to September 22nd, people could take out larger loans, and the calculation was the lesser of either $100,000 or your entire vested balance. They gave you a little bit of a break on how it was handled tax-wise. First, you didn't have to start making repayment until a year later than normal, and the first payment was going to be delayed. But there were also some particular rules that were put in place with hardship withdrawals. A hardship withdrawal is not a loan. You're actually taking money out, typically from the employer where you currently work, and there are guidelines about having to prove hardship in order to do this. First of all, this is only available from non-IRA employer plans. So if you have an employer who offers you a simple IRA or a SEP IRA, no hardship withdrawals allowed from those, but from 401ks, 403bs, and so forth. However, the plans are not required to allow hardship withdrawals, and so you would need to check with your HR department to know whether it's allowed. You will need to show that you have experienced an immediate and heavy financial need. That's the actual terminology that the IRS uses. There were other restrictions, but most of those were relaxed 2 years ago. And hardship withdrawals are taxable distributions, and they cannot be rolled over or replaced, except last year we had what were called coronavirus-related distributions. They were actually a special type of hardship withdrawal, and they could be offered both by employer plans and IRAs if they adopted the rules that allowed it. But these distributions had to be taken before the end of last year. And so if you didn't take a distribution yet or take a hardship withdrawal yet, the window has closed on taking the money out for this. You had to show some sort of COVID-19 related adverse financial consequence. And what that got you was no 10% early distribution penalty, having the taxable income for the distribution spread over 3 tax years instead of in the year that you took it out. And this is the real twist, that you were allowed to repay the amount, basically turning it into a rollover. And you were given 3 years in which to do that. And if you did repay the coronavirus related distribution within 3 years, there would be no tax. Now, so if you took one of these special distributions last year, I want to remind you that you do have 3 years to pay it back. In the meantime, you will likely be paying income tax on 1/3 of it each year. But if you pay it all off by the end of the 3 years, be sure to go back and amend those prior 2 tax year returns to remove the tax that you paid on the amount that you indeed paid back and became a non-taxable event. Sorry, these are kind of mouthfuls, but we've got those out of the way. Odds are they didn't apply to a whole lot of you, but I felt compelled, like I said, given given current circumstances that we are, some of us, still in financially difficult times with, loss of jobs or reduced hours, and loans and hardship withdrawals are probably more important to know about now than in the past, even though the special rules for coronavirus related ones have passed. And so now we'll get into the real meat that most of you are probably here for tonight, starting with rollovers and conversions. And I first learned about these was about 20 years ago when I was at a national conference. We had this big name presenter coming to talk, Bob Keebler. He's on the same par with Ed Slott, for those of you who heard Nina and I talking before the session started. And the new law had just been passed that allowed us to take money from traditional retirement accounts and convert them into Roth accounts. The Roth account was just created. All these new rules were around, and literally the law was signed on Tuesday, and Bob Keebler presented to us on Wednesday, and it was like so cutting edge and so thrilling to know about this. Well, here we are 20 years later, and yes, rollovers and conversions are still some of the most important things for us to know about when it comes to IRAs and employer plans. So what is a rollover anyway? A rollover means that you're moving money from one retirement account to another. And a rollover by definition also means that whatever the tax nature of the original account is, you're moving it over to the same type of account. If it was a tax deferred traditional account, you're moving it into another tax deferred traditional account. If the money originated from a Roth account, then you're moving it to a Roth account. So we're rolling over, we're simply preserving whatever the tax break is that that original account qualified for. Now, you can do a rollover from a retirement account to an IRA, but not all employers are going to let you take money out as a rollover when you're still working there. Those are referred to as in-service rollovers. And so previous employer plans, no problem. You're going to be able to roll money from those. But if you're still employed, you'll have to check with your HR department or check the rules before you attempt to take money out. The other thing to know about rollovers, for those of you who are likely retired and maybe have been retired for a few years, when we reach age 72 and we have required minimum distributions, if you want to do a rollover, you cannot roll over money that you are supposed to take out that year for a required minimum distribution. You would have to take out the RMD first, and then you can roll over additional amounts. But the RMD has to be taken first. Only then can you actually do a rollover, because the first money that comes out of the account each year that you have an RMD is your RMD. It has to come out first. There are some different types of rollovers though. Now the first two, as far as how they really work, are the same. So really we're talking about a distinction between the first two, the direct and trustee to trustee transfers, and the 60-day is the odd one that we're going to talk about the issues with. Because the direct and the trustee to trustee transfer really operate the same way. You're giving instructions so that money goes directly from the first custodian to the second custodian. It does not come under your control. You do not get a check made out to you. You have no opportunity to do anything with the money. The money gets sort of like playing Monopoly, do not pass go, do not collect $200. But the difference is, technically, a direct rollover starts from a retirement plan and goes either to another retirement plan or to an IRA. It's still considered a direct rollover. A trustee to trustee transfer is the same thing, except it originates from an IRA. And still, it can go to either another IRA or retirement plan. That's not the controlling factor in whether we label it direct or trustee to trustee transfer. But now let's focus on this other character, this 60-day, also known as indirect rollover, where the money is initially paid directly to you. And then you have 60 days to redeposit the money into either an IRA or another retirement plan that will accept it. But there are some pitfalls you have to watch for with 60-day rollovers. First of all, you only have 60 days to complete it. And if you miss the 60 days in general, that's going to be considered a complete taxable distribution, not much wiggling out of it, although there are a couple of exceptions we'll talk about. The biggest problem, though, is withholding, tax withholding. Now, you may be thinking, I'm going to tell them I'm going to roll this over. Why should there be any tax withholding? Because they don't know that you're going to roll it over, and the IRS is going to get its money up front. So if you take money out of an employer plan, no matter that you intend to roll it over, there's going to be 20% mandatory withholding for income taxes. And if you're taking money out of an IRA, there'll be a default of 10% withholding. So let's say that you had, we'll just pick easy numbers. Let's say that you had $10,000 in your employer plan. You tell them you want to move the money somewhere, and they ask you how you'd like it. And you say, oh, well, a check made out to me, of course. So they do that. They send you a check. But when you get it, it's only for $8,000 because $2,000 was withheld for income taxes. You think, oh, well, I'll just deposit the $8,000 in the new account. Well, if that's what you do, you now have a $2,000 taxable distribution. The only way to avoid that is you're going to have to replace. You're going to have to go find another $2,000 somewhere so that you can redeposit the whole $10,000. And then you can avoid any taxable distribution with this transaction. So the moral of this story is that direct rollovers and trustee-to-trustee transfers are more reliable, less problematic ways to move money, but you do have the right to do a 60-day rollover. There are some situations where you can get a waiver on the 60-day limit. The most clear-cut one is where you sent the money to the financial institution and you can document that they received it, but they didn't get it deposited into the account within the 60 days. Wealthy individuals who move lots of money can petition the IRS for a private letter ruling, but that is very expensive. But we now have a system that the IRS is using where we're allowed to self-certify if one of several, I don't want to say common, but acceptable and relatively common circumstances occurred where you can request a waiver of the 60-day limit. These would include things like the postal service didn't deliver it in time. If people were moving money at the end of 2020, we may have had situations like that because we did have postal delays last December. Being seriously ill, simply misplacing the check. You didn't put it anywhere else. You didn't deposit it anywhere else. The check just laid around. But if you do self-certify, the thing that you have to do is as soon as you realize, as soon as you're able, you have to then do the rollover, make the deposit ASAP. Now, one of the reasons why I have started pointing out the difference between direct rollovers and trustee-to-trustee transfers is because of this rule that hasn't been around for too many years, where there is a limit of one rollover coming from any IRA that you own in any 12-month period. Now, notice that the limit only applies to money that's coming from an IRA, which means we're really talking about those trustee-to-trustee transfers, because this rule does not apply to IRA to Roth IRA conversions. They're conversions, they're not a rollover. It doesn't apply to trustee-to-trustee transfers that go IRA to IRA. And it doesn't apply to rollovers from a retirement plan, regardless of where it goes, either to an IRA or another retirement plan. It really only applies to these direct rollovers. Indirect rollovers. So the 60-day rollover is the thing that you have the limit on. No more than one 60-day rollover from an IRA in any 12-month period. There were individuals who were doing a lot of rollovers prior to this rule, got very lax about thinking of it, and now you really have to keep track. If you did a 60-day rollover, you cannot do another one for 12 months. And one more rule about rollovers. If you're the beneficiary on a retirement account, you can do a direct rollover. So let's say that when my dad died and I had inherited part of his IRA, I could do a direct rollover from that inherited IRA to another IRA, as long as the money went directly from the first custodian to the second custodian. But if I took the money out, got a check made out to me, and tried to roll over then, I have blown it. Beneficiaries cannot do 60-day, AKA indirect rollovers. So let's assume that you're not trying to do a 60-day, you're trying to do a trustee-to-trustee transfer or a direct rollover. The second bullet is important. The title of the new account has to remain in the name of the deceased with you named as beneficiary. Something like Dan Jones, deceased, for the benefit of Jimmy Jones, beneficiary. Something like that. It has to retain the name of the original owner on the account because it's an inherited account. And if you did, instead of doing that direct rollover, try to do a 60-day as a beneficiary, again, you've broken the rules and the penalty is harsh. It will be deemed a 100% taxable distribution of the amount that you were trying to roll over. So again, moral of the story, 60-day rollovers are not your best choice in any case, but particularly not if you're a beneficiary instead of an owner. This section is called rollovers and conversions. So we're finishing up the rollover part. Now we're going to talk about this animal called a Roth conversion. Conversion, because we are converting money's tax nature. We're converting money from a traditional retirement account to a Roth account. So we're taking money that had the taxes deferred on it, and now we're putting it into an account where we must have already paid tax on that money. So converting means paying the tax on the taxable income you've created by moving it from tax deferred to Roth. So you may be thinking, oh my gosh, I've got $100,000 in this tax deferred account. I was thinking about converting it to Roth, but wow, I can't pay tax on $100,000 without using some of the $100,000. Rule of thumb, if you're going to have to dip into the account balance that you're moving to pay the tax, then financially converting may not be the thing that you should be doing right now. But what you may be able to do is to take partial conversions and manage that tax bill so that you will be able to pay it without dipping into the amount you're trying to convert. Some of you might have IRAs, or in more rare circumstances, employer plans, where in a tax deferred account, you have both deductible and non-deductible contributions. Meaning that even though it's in a tax deferred account, you weren't able to avoid paying the tax on that part of the contribution. Happens with IRAs when your income is over a certain limit and you have an employer retirement plan, you're still allowed to put money into a deductible Roth, a deductible IRA, but you're not able to actually deduct it on your income taxes. The only benefit you get is deferring tax on the growth. So when Roth accounts first came around, a lot of people who had these non-deductible contributions in their other retirement plans said, oh my gosh, I already paid tax on these non-deductible contributions. This will be a piece of cake. I'll just yank that money out of my 401k or IRA or wherever it was, plunk it into a Roth, no tax because it was non-deductible to start with. Well, the IRS had that figured out right off the bat. you can't cherry pick. They follow what's known as the cream in the coffee rule, meaning that once these non-deductible contributions have been mixed in with the deductible contributions inside the account, you cannot separate them out that way anymore. So let's say you had an IRA that had a mixture, deductible contributions and non-deductible contributions. Let's say it was 50-50. Whatever money you take out of that IRA and convert to Roth will be deemed to be 50% deductible and 50% non-deductible, because that's the cream in the coffee rule. We have to keep the same proportion as what it was to start with in the plan. One way that we can make Roth conversions now that wasn't allowed in the early days is what's known as an in-plan conversion. In-plan means that in your 401k or your other employer plan, it offers both tax deferred and Roth versions. In that case, you don't even have to take the money out of the plan to convert it. You do it within the plan. That's why it's known as an in-plan conversion. So through your 401k at work, if Fidelity is your custodian, Fidelity would basically just do some accounting that switched it to a different column, and lo and behold, now it's in a Roth account. Still taxable, doesn't avoid that, but it's a very simple way to make a conversion. And of course, you can take money from a retirement plan that's tax deferred and convert it to a Roth IRA. You can convert between a tax deferred IRA and a Roth IRA. Those are all ways of doing Roth conversions. And when should you think about it? The obvious time to consider doing a Roth conversion is when you're in a year where you have lower income than usual or large deductions, either of which can put you in a lower tax bracket than you normally are in. And so you might consider doing a Roth conversion to take advantage of the fact that instead of being in the 22% tax bracket this year, you're in the 12% tax bracket. Take enough Roth conversion to fill up that 12% tax bucket. And if you're saying, you know, I don't really need the money for a while that's in my retirement accounts, but I'm going to be faced with required minimum distributions pretty soon. I really don't want to have to take required minimum distributions. Well, in that case, having money in a Roth IRA might be appealing to you, because Roth IRAs are the only type of retirement account we have that does not call for required minimum distributions. So some people look at conversions to Roth IRAs because of the desire to avoid RMDs. People with larger estates might think about doing conversions because they want to reduce the size of their estate and therefore reduce the amount of estate tax that will be owed. So converting to Roth, paying the tax means a smaller estate. Right now in 2021, individuals can leave $11.7 million before estate tax is owed. So we really are talking about wealthier individuals. Now, heads up that barring future legislation, the rules will revert back to the prior rules in 2026, and that 11.7 million will drop back to about half. It'll be 5 million plus whatever inflation adjustments will be made for the interim years. So rollovers and conversions imply that we're not really taking the money out to use it now, and we aren't taking required minimum distributions. So let's now focus on these regular distributions, not rollovers, not conversions. We're actually taking money out of the plans, probably to live on it, because that's what we were putting it there to start with. The distribution rules are age driven. If you are not yet age 59 and a half, under the IRS rules, you are deemed to be too young to retire, or at least too young to be taking money out of your retirement account. So they put a barrier in place. These are known as early distributions, and generally they are hit, in addition to tax, they're also hit with a 10% penalty. However, the penalty doesn't apply to 457s that were operated by state and local governments. There are some other exceptions that we'll cover in a moment, but remember that the general rule is If you take money out of a retirement account before age 59 and a half, it's not only taxable, but there'll be a 10% penalty. Once you reach age 59 and a half, though, from then up until the year before you turn 72, I call you the golden group. You can do whatever you want. There are no penalties if you take money out, but there are also no requirements that you have to take money out. You can leave it all in, you can take it all out, take a chunk out now and take nothing out next year, whatever you want, the golden years. But when you reach age 72, and for each year thereafter, you will have a required minimum distribution that we abbreviate as RMD. You have to take the RMD by the end of the year, December 31st. The one exception to that December 31st deadline is your first distribution. Your first distribution can be delayed until April 1st of the year following the year you turn 72. And that date is known as your required beginning date. So for your first distribution, you could delay as late as January, February, or March of the year after the year you turn 72. That's a grace period that applies to that first RMD. But if you do that, take note that that means you'll also have to take your RMD for the year you're 73 by December 31st. That gives you 2 taxable distributions within 1 calendar year. For most of us, that means 1 tax year. That may push part of your income into a higher tax bracket, although some people may do this intentionally if for some reason the year that they're 72 is a particularly higher income year. So this is all about tax planning, whether or not you want to use that grace period. But here's why you don't want to miss taking a required minimum distribution. The penalty is substantial. As it says on the bottom bullet here, it's a 50% penalty for any amount that you were supposed to take and did not. So if your RMD was $10,000 for this year, you only took 5, you kind of lollygagged around and forgot about the rest. Then when you file your taxes next year, in addition to paying tax on the $5,000 you took, you'll then owe a 50% penalty on the $5,000 that you should have taken, plus the tax, and you have to get the money out, or there may be an additional penalty the next year. Now, going back to those early distribution penalties that apply when you're under age 59 and a half, I said there were exceptions. Here are the main ones. If the owner is deceased, then their death provides an exception for their heirs to take money out without penalty. If the individual is disabled, the owner is disabled, again, that's an exception for the 10% penalty. Same thing if an account was divided under a qualified domestic relief order associated with a divorce, that's an exception. You can also follow rules about taking out a series of substantially equal payments to avoid the penalty. For employer plans only, taking money out of the employer plan when you leave work at or after the age of 55, that's an exception, but it only applies to that employer plan, does not apply to IRAs. But IRAs also have a couple of their own exceptions when you use the distribution either for qualified higher education expenses or for first-time homebuyer expenses. There was a new exception put into place by the Secure Act. The Secure Act was actually a very major piece of legislation that passed in December of 2019, but the pandemic came so close on its heels and the CARES Act so shortly after that, that the changes that were implemented by the Secure Act kind of got lost in the shuffle. So this is the first one that we're going to encounter tonight, actually the second one. Changing the required minimum distribution age to 72 was one of the biggest things that the Secure Act did, because as you probably well know, the age used to be 70 and a half. It is now age 72. So no longer do you need to celebrate half birthdays to keep up with your IRA distributions and so forth. But on the early distribution penalty, the new exception that was put out by the Secure Act is for parents who either have a child by childbirth or they adopt. and they are allowed to take out up to $5,000 per parent per qualifying event. And this is the only early distribution exception that also allows you to basically turn it into a rollover to repay the amount later on. So that's unique. A lot of people want to know, how do you calculate a required minimum distribution? For whatever account you're looking at, let's say it's your 401k from a previous employer, you need to look at your statement from the end of the previous year. So if I'm calculating my RMD for this year, 2021, I need to look at my statement from December 31st, 2020, look at what my balance is. I go to IRS publication 590-B, and I go to the uniform lifetime table, which is in the appendix. I find my age, and I find the distribution period, the number that's beside it. You take that distribution period and you divide it into the account balance that we already found on your statement. That tells you how much you have to take out by December 31st. That number in the uniform lifetime table, because you may have wondered, let me flip back. You may have wondered, for a 72-year-old, this distribution period is 25.6. What is that? What does that represent? And a lot of people will guess, oh, maybe life expectancy. Yes, but 72-year-olds don't have a 25-year life expectancy. It's more like 16. What the uniform lifetime table does is it assumes, it gives you a theoretical spouse who is 10 years younger than you. And this is the joint life expectancy of a 72-year-old and a spouse 10 years younger than them. And then each year you go back to the table and you're still assumed, even when you're 85 or 95, you're still assumed to have this theoretical spouse who's 10 years younger than you. The benefit is, by assuming that younger spouse and by giving us a longer life expectancy, it means that our required minimum distributions are smaller than they would be if we were only looking at our own life expectancy, or even the joint life expectancy and us and a spouse who was closer to age, closer in age to us, or perhaps even a spouse who's older. You can have a spouse who's 10 years older than you. On this table, you still have a spouse who's 10 years younger. The exception is, if you actually do have a spouse who's more than 10 years younger than you, you use a separate table that uses your actual ages. And when a beneficiary inherits an account, they use a single life table to the extent that they're able to use life expectancy. And we'll talk quite a bit about that toward the end. RMDs are calculated per retirement account. If you have a 401k because you worked in the corporate environment perhaps for years, but you also worked in government and maybe even in nonprofits. So you might have a 401k, a 403b, and a 457, along with an IRA or two. You're going to have to take an RMD from each of those accounts, with two exceptions. If you have multiple IRAs, you can add up their balances and calculate a single RMD amount. And you can take that RMD all from one IRA or spread it across all the IRAs. It doesn't matter, as long as you take out at least the minimum amount. And similarly, if you happen to have multiple 403b accounts, you can do the same thing. You can, the balances all up together, calculate a single RMD, and then take it from one or more of those 403b accounts. But otherwise, you take an RMD for every retirement account that you have. The one other exception is that if you are still working for an employer where you have a retirement account, you do not have to take an RMD while you're still working for that employer, or if it's your own business. Now here's perhaps the high point of tonight, where I get to talk about a way for you to avoid paying any tax on a required minimum distribution. This is pretty powerful stuff. This is the one legal way to do this. And it's done using something called a qualified charitable distribution. abbreviated as a QCD. QCDs can only be taken from IRAs and only individual IRAs. You can't take it from an employer IRA like a SEP or a simple IRA. So it has to come from an IRA. You have to be at least age 70 and a half. That's not a typo. They did not change this to 72 to match up with the actual RMD rules. So for qualified charitable distributions, the qualifying age is still 70 and a half. And pay attention, not the year you turn 70 and a half. You have to have actually passed 70 and a half before the date that you do the qualified charitable distribution. The distribution has to go directly to charity. Think of it like a rollover to a charity. It operates in the same way. You instruct the custodian of your retirement account to send the money directly to the charity, or to write a check to the charity, but send the check to you. You could then have the honor of presenting it, but you never had control of the money. That's the key factor here. It's a pretty lenient limit, up to $100,000 per person per year. And qualified charitable distributions typically have greater tax, they give us a bigger tax break than itemizing charitable contributions and taking the credit that way. This will be particularly true through 2025 while we're still under the current tax rules, which, if you recall, basically doubled our standard deduction amounts. So let me kind of outline for you how that would work. Let's say that you're feeling charitably inclined this year. You have an IRA that you could take the money from, and you have passed 70 and a half, so you're eligible to do this. $10,000 is well within the limit. And so you're debating, do I do a QCD, a qualified charitable distribution, from my IRA, or do I just write a check to the charity the way I would normally do it? Well, let's first look at what happens if you write the check. That means that you're counting on taking itemized deductions. Well, this red line here represents the amount that you can take on the, the amount that you can take as a standard deduction. And so you only benefit from itemized deductions to the extent that your itemized deductions exceed that red line. So let's look at what somebody's itemized deductions with this $10,000 charitable contribution might look like. First, let's start at the bottom. Yes, state income tax and property tax are still deductible on your income taxes, but only up to a $10,000 limit. So it doesn't matter if you had a total of $12,000 or $14,000 of state income tax and property tax that you paid. You can only itemize $10,000 of it. All right, so this box is $10,000 of itemized deductions. If you're paying a mortgage on your home, maybe you paid $7,000 in mortgage interest last year. Okay, that's cool. As long as the mortgage wasn't for more than $750,000 and it's actually a mortgage that you use to either buy or improve the home. And then we layer your charitable contributions on top of that. The charitable contributions only take us $2,200 above the standard deduction amount. So really, that's the only benefit tax-wise we got from our $10,000 charitable contribution, was an additional itemized deduction of $2,200. Compare that with if we took the standard deduction, and for married filing jointly, we get the whole whopping $24,800 without itemizing anything. Then we use a qualified charitable distribution to take $10,000 from our IRA and send it to the charity. And we get to write off, basically, that whole $10,000. I shouldn't say write off. It's actually better than that. It's income that literally disappears on your tax form. You write down that you had a $10,000 taxable distribution from your IRA, and then you say, and how much of it was really taxable? Zero. because it was a qualified charitable distribution. The whole $10,000 of income evaporates. And so the advantage is significantly higher. Sorry, I'm having a little trouble with my buttons here tonight. Okay, and this is just a little additional information about other reasons that a qualified charitable deduction could be more valuable to you than making a charitable contribution and claiming it as an itemized deduction the way you've probably done it in the past. We already talked about that you get the full tax benefit under the qualified charitable distribution up to the $100,000 that's allowed by law. But because it's income that is removed on your tax form above the line where you calculate your adjusted gross income, adjusted gross income is the number that drives a lot of other taxes that we pay or benefits that we qualify for. And so by reducing your adjusted gross income, you might either avoid or reduce paying tax on Social Security benefits, because how much of your Social Security benefits are taxable is based on your adjusted gross income. Reduce adjusted gross income, potentially reduce the amount of tax that you pay on Social Security benefits. Same thing with your Medicare premiums. Higher income, higher Medicare premiums. So reduce the income, perhaps avoid that increase. If you have more than $200,000 of income as a single person or $250,000 as married filing jointly, you may be subject to the net investment tax. So again, reducing adjusted gross income might take you under the level and help you avoid paying the net investment tax. And you might qualify for additional tax breaks related to education expenses and things like that. The itemized deduction cannot do any of these things for you. There was this concern. Personally, I think that they were worried about something that's a non-issue, but there was a concern that two changes from the Secure Act could be abused when combined. And the two things are that not only are you allowed to make a qualified charitable distribution at age 70 and a half, but also that if you continue to have earned income as an older adult, you can continue to make traditional IRA contributions. There used to be an age limit. You used to not be able to contribute to an IRA, or at least a tax-deferred IRA, beyond 70 and a half. That rule is gone. So they were concerned that you're going to basically contribute money to your IRA and immediately pull it out as a qualified charitable distribution, and they didn't want that to happen. So if you're still working, you still have earned income, and you plan to make deductible IRA contributions in the year you reach 70 and a half or later, know that you will not be allowed to take a qualified charitable distribution until you have already taken out as much in distributions as you contributed after the age of 70 and a half. Yes, it's convoluted. Supposedly there are some sophisticated ways to work around this. For most of us, I don't think there's enough money here at stake to try to work around it. But if you do want to deal with this, or you're already in this position, get some good expert tax advice that will guide you through these rules and how to deal with it. All right, let's talk about some special rules for Roth accounts as far as distributions. Remember that the money in your Roth account consists of two parts. One is the contributions that you made. And what we know about contributions in a Roth account is that we already paid income tax on that. We will not owe income tax again. And we also won't owe any penalty when we take it out of a Roth account. So when you have a Roth account, first part of the money is contributions. The other part is the growth in the account. Whenever you withdraw contributions, there will never be any tax or penalty. The only question is, how do we make the growth in the account be tax and penalty free? It's a two-part rule. The account must have been open for at least 5 years, and you must either be age 59 and a half or older, or dead, or disabled. And you have to meet two. You have to meet the 5-year part of that rule, and you have to meet one of the 3 items in the second part of the rule. Then any growth that you take out of the account is also tax and penalty free. Kind of like the old cream in the coffee rule that I talked about previously. Generally, when you take money out of a Roth account, it'll be deemed to be part contribution and part growth. So the 5-year rule is always important. The exception is Roth IRAs. Roth IRAs are this very nimble, very flexible retirement account. When you take money out of a Roth IRA, the rules change. You're deemed to be taking contributions out as long as there are any contributions left in your Roth IRA. And only then will you be taking out growth. And so only then are you concerned about the 5-year rule and being 59.5, etc. Why is this important? Well, to those of us who are middle-aged and above, probably not too big of a deal. But for my niece a couple of years ago, who was 28, had managed to build up a little bit of an emergency fund and had a few more dollars that she wanted to do something wise with. And we talked. She's 40 years away from when she might be able to use retirement money. But a Roth IRA seemed more approachable, seemed more user-friendly than a traditional IRA or even an employer plan, because whatever money she contributed to that Roth IRA, if she found herself in a really hard place and she needed the money, she could always take out her contributions, no penalties, no tax, no problem. And only if she took out additional money that was growth, then we'd be worried about taxes and penalties. So it's a very comfortable way for a younger adult, a long way away from retirement, to start to put money into some sort of retirement plan. Now, if they had an employer plan that had matching, that would be probably the first place they would want to go, but she didn't have that. And so the Roth IRA seemed to be a good choice for her. So as I said, distributions in Roth IRAs and only Roth IRAs, not Roth 401ks, not Roth 403bs. The distributions come out first. And there are no required minimum distributions for the owner, although there are required minimum distributions for the beneficiaries after the owner's death. So these are both special rules that apply just to Roth IRAs. While we're talking about required minimum distributions, for those of you who might have taken your 401k or your IRA and you took it in the form of an annuity so that you have a guaranteed monthly payment, just wanted to let you know that that annuitization, that's what it's called that you did, that annuitization will satisfy the required minimum distribution rules. And if you happen to take one of the new types of annuities where it's a deferred annuity, you retired, let's say at 65, but you took part of your 401k and agreed not to start getting any money from it until you hit 75. That will also still qualify for your RMD amount. And those deferred guaranteed monthly benefits are becoming more widely available. They are a tool for planning for expenses later in life when we don't know how long we're going to live. And now we'll start talking about beneficiaries. This is where you're going to see most of the changes regarding the Secure Act. We talked about the change in RMDs going up to age 72. That was because of the Secure Act. We talked about the new exception to the 10% early distribution penalty for parents, either through childbirth or by adoption. That was Secure Act, but this is where the main impact of the Secure Act is felt. But before we get to that, if you have a retirement account, you want to choose and name beneficiaries on the account. You can name primary beneficiaries and secondary who would inherit if one or more of the primary have predeceased them. Naming beneficiaries enables these accounts to avoid probate, meaning it's simpler and easier for the beneficiaries to get to become in control of the account with less delay, typically less cost to the estate as well. But if you did previously name beneficiaries on these accounts, you may want to review those now, considering the changes made by the Secure Act. It may have affected who or what is the best choice for you as beneficiary. The changes that the Secure Act put into effect were effective for deaths on and after January the 1st of 2020 for most retirement plans, IRAs, and most employer plans. But there were some exceptions I've listed for you here where the new rules only go into effect starting January 1st of next year. If deaths occurred, but here's what you should know. Any death that occurred before January 1st of 2020 was under the old rules. So the things I talk about now do not apply to those earlier deaths, okay? Only since January 1st of 2020, or in some cases, deaths that would occur starting January 1 of next year. What changed? Previously, we had two types of beneficiaries. We had the big green box, designated beneficiaries, which at that point was basically any person that you named and certain trusts. And then we had the brown box, non-designated beneficiaries, which are entities. They are non-persons. That includes charities, certain kinds of trusts, and your estate. Whether you named the estate itself as your beneficiary or whether you failed to name a beneficiary and then the estate became your beneficiary by default. All of those were considered non-designated beneficiaries. They're not people. They don't have life expectancies. Now, when we're talking about people that we named as beneficiaries, we now have two categories. The Secure Act carved out this bright green box here and created something called eligible designated beneficiaries. These are the only beneficiaries under today's rules who can use their own life expectancy to calculate their RMDs as beneficiaries. Eligible designated beneficiaries are a fairly limited group of people. Surviving spouse is one. Naming a disabled individual, disabled under Social Security rules, which are pretty stringent. Chronically ill persons. Someone who was within 10 years of age with the deceased. The decedent's minor child, but spoiler alert, only until the child reaches the age of majority, and certain trusts. If you named a person as a beneficiary who is not one of these in the light green box, they can no longer use their life expectancy to calculate the distributions. So to say it differently, here are the general rules for these three categories of beneficiaries. Eligible designated beneficiaries can do what we've always in the past referred to the stretch distribution using beneficiary life expectancy. This was previously the general rule, but now it's only for eligible designated beneficiaries. They do have to take an RMD each year as a beneficiary. And as I already told you, when we're talking about eligible designated beneficiaries, yes, minor children of the deceased are on the list, but they only get to do RMDs based on their life expectancy until they reach majority. Then they become just a regular designated beneficiary. And the general rule for them is 10 years. They have to empty the account within 10 years, no more stretch over their lifetime. During the first 9 years, technically, there are no required minimum distributions. Required minimum distributions only come in year 10 when you have to take the whole thing. That's actually going to drive some of the things I'm going to talk about next as far as what you thought was a smart choice as far as a beneficiary under the old rules might not be going forward, particularly if it was a trust. Now, one thing that did not change under the rules, non-designated beneficiaries, again, charities, most trusts and estates, they have always been under the 5-year rule. They're still under the 5-year rule, meaning that they have to empty the account within 5 years. And there aren't any required minimum distributions in years 1 through 4, although they can take money out. The one exception to that 5-year rule is if the deceased died after the required beginning date. Remember, April 1st of the year following the year you turned 72. If the deceased was past that date before they died, then the charity or the estate or the trust can use the deceased's remaining life expectancy. That's another quirk of IRS rules, that a deceased individual is still viewed as having a life expectancy. Kind of an oxymoron there. Some special rules apply if you are a surviving spouse regarding the rules for how you take distributions from those beneficiary retirement accounts. First thing that a spouse can do, which is unique totally to the spouse, is they can treat the account as if it was their own from the beginning, as if they were the owner. That lets them name their own beneficiaries, and it means that the distributions will be based on their age. The rules that apply are based on their age. That means that the surviving spouse who now takes the account as their own, if they have not yet passed age 59 and a half, there will be a 10% early distribution penalty. But then they won't actually have to take RMDs until they, the survivor, reach age 72. This is often a good choice for a spouse, a surviving spouse who is not going to need money from this account until they are past age 59 and a half, or if they don't want to be required to take RMDs until they themselves reach age 72. The alternative is to treat themselves as an eligible designated beneficiary. Remember, we said spouses are eligible designated beneficiaries unless they choose not to be, unless they choose to be treated as the owner. Eligible designated beneficiaries take RMDs over their life expectancy. So if the surviving spouse, let's say, is 62, she will take RMDs over the remainder of her lifetime, but she doesn't have to take any until the deceased would have been 72 if they weren't already. And if she's under age 59 and a half and she needs money from the account, there's no early distribution penalty because death is an exception, as long as she takes it as a beneficiary. So a few more impacts of the new rules under the Secure Act. If you listen to the tax experts, one would think that everybody's goal for retirement accounts was to be able to stretch the distributions out over decades and decades. The reality is that most retirement accounts were emptied within 1 or 4 or 5 or 6 years to start with. And so long-term stretch outs were never really used by most individuals. But if stretching out the distributions over the longest possible period is the goal, spouse beneficiaries are now a better tool for accomplishing that than naming kids. Because if you name your spouse as the beneficiary, the surviving spouse then can use their life expectancy to take distributions as a beneficiary, and whoever the next beneficiary is will have another 10 years. So you've got the spouse's life expectancy plus another 10 years to stretch these distributions out. The flip side of this, though, is that naming very young beneficiaries is not as advantageous as it used to be. First of all, because they're going to be under the 10-year rule, not life expectancy distributions. Young beneficiaries are going to have to take it over just 10 years, unless they're the minor child of the deceased. But even they, let's say you've got a minor child who's 12. They will get to take distributions until they're 18 based on their age. But after that, it's just 10 years. So all you got there was 16 years of distributions. And naming a trust is less advantageous than it was before too, as far as stretching out these distributions. Now, if you have never named a trust as a beneficiary on one of your accounts, haven't contemplated naming a trust, you can just kind of, start writing your questions into the Q&A while we talk about this. But for those of you that trusts are a factor in your estate planning, this may be useful information for you, because there were some significant impacts here from the Secure Act. See-through trusts have been used as beneficiaries of IRAs for a long time. It was a way to control post-death distributions so that your heirs couldn't take everything out and spend it too fast. It also allowed the beneficiaries to stretch those distributions out and have a smaller overall income tax impact, minimizing taxes for the beneficiaries. And previously, we were able to accomplish those things with a see-through trust where the ages of the beneficiaries were used to determine a life expectancy. And see-through really means that the tax code would look through the trust to the actual beneficiaries and use their life expectancies. But under the new rules, these trusts have by and large lost those advantages. If you're interested, here's a quick definition of what a see-through trust is. This is slide 43 if you want to note that in your handout. But here are the problems with see-through trust under today's rules. There are two types. There's a conduit trust and there's a discretionary trust. Both can qualify as see-through, but they both have problems under the new rules. The conduit trust would typically require the required minimum distributions to be paid out each year to the beneficiaries. So not only would the trust take the RMD, but it would pass it through to the beneficiaries. And it was a way of, again, spreading income and therefore taxes over a number of years. But under the current rules, there are no RMDs for designated beneficiaries in years 1 through 9. The only RMD is really the full value of the account to be distributed in year 10. So it's no longer tax efficient and it's no longer giving the money to the beneficiaries in dribs and drabs. The other type of trust, the discretionary trust, it's discretionary because it doesn't have to pay out the money. It doesn't have to pay out the income to the heirs. And so it could retain the RMDs and therefore the control when it held the RMDs in the trust instead of paying out. But the problem here is now the trust is the one who has to declare those RMDs as income, and trusts pay very high income tax rates. A trust will hit the highest income tax rate, which is currently 37%, when they have just $13,000 in round figures of income. Compare that to an individual, or a married couple filing jointly, that's the number I've given you here. They don't hit the highest tax bracket until they hit over $600,000 of income. So yes, discretionary trusts can still be used, but you're going to be paying a tax penalty in essence if you do use them to try to retain control of the money being paid out from your retirement accounts. So the rules of trying to figure out whether a conduit trust or a discretionary trust or see-through trusts are slightly different. Why does it matter? Because you could make a conduit trust, probably not a discretionary trust, that would qualify as one of those special eligible designated beneficiaries, the ones who actually can use their life expectancy. But it's really jumping through a lot of hoops, and most trusts are not going to make it. So I'm going to move, this is the verbal description, but here's the graphical description of what I'm trying to say. In order for a see-through trust to be productive under today's rules, it would have to be a trust that can be treated as an eligible designated beneficiary and use the stretch distribution over the beneficiary's life expectancy. That means that the trust is the most useful if we end up in this box here, that the trust can be considered an eligible designated beneficiary, not just a designated beneficiary, not for sure a non-designated beneficiary. Well, how does a trust end up here? Let's kind of follow it backwards. Okay, first question is it a see-through trust? Well, if the answer is no, then it's a non-designated beneficiary, period. But if it is a see-through trust, next question is, what type is it? Discretionary? Well, it's going to end up being designated or non-designated. It doesn't end up here ever. If it's conduit, all right, then the question is, are all of the primary beneficiaries eligible designated beneficiaries? Then and only then will this trust itself be considered an eligible designated beneficiary and achieve what the trust was designed to do to start with. If it doesn't end up in that box, it's not doing what it was designed to do for you. Maybe a time to revisit the use of that trust and your beneficiary designations with your estate planning attorney. So we covered a lot of stuff tonight. I want you to take a moment and just kind of reflect and think about what should I do with what I learned tonight? One thing might be to review whether you've named beneficiaries or not. And if so, and if you did, who are they? Based on what we talked about tonight, does that still sound sensible? Maybe you need to schedule an appointment with an attorney or with a financial planner to talk about these issues and make sure that you understand them and if you're acting on good guidance that matches your individual circumstances. Other actions you might want to take are make a note of what year you turn 72 and remember that that's when your RMDs start now. Or if you're a beneficiary of any type of retirement account or expect to be, now you know that generally you will have to empty the account within 10 years and that you could do a rollover. Let's say that the custodian where the account is when you inherit it says, yeah, the federal government will let you wait 10 years to take the money out, but we're not going to let you wait 10 years. They can actually do that. In that case, you might be looking for a new custodian for the account who says, yeah, we'll let you leave the money sitting here with us until the end of the 10 years. No worries. So that you've at least preserved your options and are not forced to take all the money out in the first year after the death of your loved one. So those are some of the kinds of things that might pertain to your situation. And I would encourage you to make a note of what things you want to think about, check on, talk to an expert about regarding what you learned here tonight. And as I mentioned earlier, there are a number of resources, a number of links that I have put on my website for you on this topic. Originally, I was using these in a different class I taught called Getting the Most for Your Retirement Dollars. So you can strike that out on your handout. What you're looking for now is this lesson title. Just go to KarenChanFinancialEd.com, go to the resources tab, and actually you can either click on this one, same information, or click on the title of tonight's program, Taking Distributions from Retirement Plans. And then I also have information posted on my website regarding all the special rules for retirement accounts under the CARES Act. And it's been fully updated now to reflect all of the new programs that were either started or expanded under the new American Rescue Plan. So if you have questions about any of the stuff related to COVID, whether it's economic impact payments or unemployment insurance or whatever, that tab will give you a lot of information and link you to reliable sources for more there. So that's about things that you might want to follow up on later. So Nina has been monitoring for your questions, I think, in the Q&A, yep. Or perhaps if they put them in chat, you've probably been looking at that too.
Yep.
So what do we got?
First one comes from Frank. When you take distribution from a 401k, are taxes taken out right away, or do you do that when you do your taxes in the following year?
It can be, okay, usually from an employer plan, they are going to be withheld. And then if there's any additional that you owe, or if you do a refund on it, that will be taken care of when you file your tax return. If it's an IRA, you're going to have some discretion there. You can ask for there to be no withholding, or you can ask for the amount of withholding that you think it needs to be, so that you don't end up having owing money, and perhaps therefore also owing an income tax penalty the next year. So with IRAs, you have a lot of control there. With retirement accounts, it is 20% mandatory. You may be able to request for it to be more if you think you need to withhold more. But this is actually why many retirees end up filing and paying estimated income taxes, because some of our income doesn't automatically have withholding, or it's not enough. And so estimated taxes paid quarterly are the way we work around that. The first year as a retiree actually is the one time that you can get a waiver if you underpaid your taxes by too much before you filed. That's actually an exception to having a penalty for that. But in every other year, you want to be within $1,000 generally of what you owe. If you owe more than that, you may be at risk of having a penalty. So hope that helped, Frank.
Okay, this is from Joni. Are there any distribution COVID hardship is there any distributions COVID hardship included in the latest relief package passed this spring?
No, there was not. The only relief on distributions from retirement accounts was under the CARES Act. It was all last year, and so the window has closed on those. You might still be eligible for a standard hardship withdrawal if it's an employer plan that allows that. You might also be able to take a loan, particularly if it is an employer plan that allows that. The rules will be a little more stringent because we'll be under the regular rules instead of the more lenient rules last year, but those could still be options for you.
This is the first of two from Laura. If you contribute to an IRA in 2020 and it is determined to be a non-deductible contribution when doing the 2020 tax return, can you convert that specific amount to a Roth IRA before the due date of the return? Meaning, can you pinpoint that specific contribution without having to use the cream in the coffee rule?
Yes, because at that point, it's not considered a conversion, it's considered a recharacterization. Sounds like mincing words, but words are important when you're talking about taxes. Before you file your taxes and you figure out that, yeah, I made a non-deductible contribution, I could have made a Roth contribution, you get in touch with the custodian where it is, you ask them to recharacterize it. Shouldn't be a problem. Some places even have it set up where you can fill out a form online and have it done automatically. There are two cases I'm aware of where you can recharacterize contributions this way. One is where you want to change the tax nature of the contribution before your tax filing due date. And the second is if there are any self-employed people listening tonight, and if you have, let's say, a solo 401k that you're putting money into, and you put it into the tax deferred part, and you realize it would have been more advantageous if you put it in the Roth part. You can recharacterize that just by working with your custodian before the due date of your taxes.
And then Laura's other question is, can you do a QCD on the RMD of an inherited IRA?
Yes. Thank you for asking.
This is from Jeanette. What if your beneficiary is a niece or nephew over or under 10 years younger than the deceased? What if unrelated
hold
to
on
the
a second.
beneficiary?
I'm gonna make myself a note here. As far as that beneficiary thing, I need to check though. You would still be under the age 72 requirement. I need to look that one up to be sure. So as far as whether a beneficiary can do a QCD, I think the answer is yes, but I want to look up the details for you. Okay, so if we don't get that done before we sign off tonight, if that individual would please either email the question to Nina so she can forward it, or go to my webpage, click on Contact Karen, and type your question in there with your email address so I can look up the details on beneficiaries and qualified charitable distributions, because I haven't have read that recently, and I want to make sure I got that right for you.
Okay.
All right.
That's easy.
So now my mind is open and I can listen to the question about the 10-year-old.
Okay. What if your best beneficiary is a niece or nephew over or under 10 years younger than deceased? What if unrelated beneficiary?
Okay. If they are within 10 years of the age of the deceased, then they are an eligible beneficiary, an eligible designated beneficiary, regardless of relationship. It is strictly age-based. So like you said, if it's a niece or nephew, it's your next door neighbor. If the deceased was 75 and this individual is 65 or older, you're good to go, as I understand it.
Okay, Linda, yes, there is a handout for this webinar. I emailed it to you today. So if you didn't get that, let me know and I'll resend it to you tomorrow. Thank you very much. Okay. Anonymous, I recently left my employer. I am planning to close out my 401k that is mixed Roth and traditional. I was planning on doing a 60-day rollover into the Roth IRA. Are there extra steps that I would need to convert the traditional funds? I am anticipating paying the taxes on the traditional funds.
Okay. You can take money directly from traditional tax deferred money in a 401k and convert it directly into a Roth IRA. Years ago, it wasn't allowed. You had to do a two-step process, but that was changed several years back. So not a problem. Now, you might have to fill out 2 sets of paperwork because you have tax deferred money and Roth money that you're moving all to a Roth. But no need to put it into a separate account and then convert it. You can do it all in one step.
Okay, looks like the last question is, what is the best strategy to use all of your retirement money but not outlive it?
Okay. The answer to your question is an annuity. There's really nothing else that can make sure that your life expectancy and your money match up perfectly. Now, I'm not talking about variable annuities. I am not talking about indexed annuities. I'm talking about the plain vanilla fixed annuity. They're often called lifetime annuities, but it's where you hand over an amount of money. The annuity, the life insurance company gives you a guaranteed dollar amount per month for the remainder of your life. You get that amount every month for the rest of your life. And when you die, the contract's up. Now, that doesn't mean it's the right thing to do for everybody, and you should never do it with all of your money. But the way the question was phrased, that's what an annuity does. But it doesn't mean it's the right choice for everybody. And you should, and even if an annuity is a good choice for you, probably only the lifetime annuity, the fixed annuity that we're talking about, and only to be done with a portion of your assets, not the majority.
Okay. Well, that's all the questions, Karen.
Okay.
Thank you.
Well, we only got one that I wasn't sure about, so that's not too bad.
Hey, it's pretty good. You covered a lot of information. My head's kind of swimming, but it was a great program once again. Well, so thanks everyone for signing on the call tonight. I appreciate it. We had 25 people, so that's a good number. So, okay, drive safe home. Okay.
Thanks, Nina. Thank you to the library for thinking this is important.
Oh, sure. All right. Bye-bye.